faithfully delivering value and interpreting great books from around the world. Hi, this is Sally talking books. Today, I'm interpreting this book for you called Technical Analysis of Stock Trends. This book is hailed as the Bible of the securities trading field and is widely recognized as an investment treasure trove. Although the title is Technical Analysis of Stock Trends, the trading methods in the book are also useful for futures, forex, and other financial derivatives trading. Robert Precher, the master of Elliott wave theory, said he couldn't find a better introductory book on securities. The famous technical analysis master, John Murphy, even called this book a monumental classic in technical analysis. The book was first published in 1948 with two authors. One is Robert Edwards, a seasoned expert in Dow theory. The other author is John McGee, who graduated from MIT. He created famous stock price charting methods and did groundbreaking research on the stock market in the mid-20th century. Edwards and McGee are both called the fathers of technical analysis. Oh, From 1942 to 1948, they worked together on technical analysis research. In 1948, they compiled their years of research into a book, and thus we have this technical analysis of stock trends. Starting from the 8th edition of this book, McGee's student, Bassetti, joined as an author. He revised the entire book in great detail and added a lot of new content. Today, I'm interpreting the latest 10th edition. Since the first edition, this book has been around for 70 years. Back then, stock charts had to be drawn by hand, stroke by stroke. Nowadays, you just need to open stock trading software on a computer or phone, and you can get any chart you want. However, the core content of technical analysis hasn't changed. It has stood the test of time. Next, we'll proceed to explain according to the structure of this book in 2 steps. The first part discusses trend technical theory, and the second part is about trading tactics. First, let's enter the first part, trends. In the trading world, there have always been 2 major schools, fundamental analysis and technical analysis. The fundamental analysis school mainly looks at the financial data of listed companies, assessing their profitability to determine if the stock is overvalued or undervalued and whether to buy or sell. Apart from some newcomers to the stock market, few people rely purely on fundamentals to trade stocks. For technical analysts, there are countless stock cases proving huge gaps between companies' intrinsic value and actual prices. After studying fundamentals extensively, the effort often proves futile. Take U.S. Steel stock, for example. Priced at $261 in fall 1929, it plummeted to $22 by June 1932. By March 1937, the price rebounded to $126. Yet just 1 year later, it crashed back to $38. You see, this stock price behaved like a roller coaster ride. So how did its fundamentals look? Book value per share was $244 at end 1929, $187 in 1932, and $151 in 1937. This data shows a gentle downward trend. Clearly, no correlation existed between fundamentals and price movements. In reality, stock prices are entirely determined by market supply and demand. Technical analysts claim they could predict trends just from charts, without even knowing the company name or industry. So what exactly is technical analysis? It studies patterns in price charts to determine trend direction and make buy or sell decisions. Simply put, technical analysis deciphers markets, and charts are its essential tool. Since this book was published in 1948, it includes sections on manual chart drawing. We can skip those chapters now and focus directly on analysis methods. The book presents 4 chart analysis methods. First examines price patterns and volume, reflecting supply-demand dynamics. Patterns are recognizable shapes formed by price fluctuations on charts. Patterns fall into 2 categories, reversal and consolidation. First, let's discuss reversal patterns. Reversal patterns indicate trend changes. They appear when prices shift from rising to falling or falling to rising. In most cases, when a stock price trend reverses, a reversal pattern appears on the chart. The primary task for technical analysts is to recognize which reversal patterns are significant and judge their reversal potential. The most common and reliable reversal pattern is the head and shoulders pattern. In the audiobook notes, we have an illustration of this pattern. You can see how it signals an impending trend change when it appears on the chart. As the name suggests, the head and shoulders pattern resembles a human head and shoulders. It consists of three peaks, with the highest central one called the head, and the two lower peaks on either side called the left and right shoulders. Theoretically, the left and right shoulders should be symmetrical, but in actual charts, the shoulders often aren't equally high. Sometimes the left is higher, sometimes the right. Minor height deviations are generally acceptable. For a relatively standard head and shoulders pattern, it begins with forming the left shoulder. This involves a strong upward surge where the stock price rises sharply with significantly increased volume, followed by a price adjustment where volume contracts. Thus, a small peak forms, establishing the left shoulder. Next, another surge occurs with rising price and volume higher than the previous one, forming a taller peak. This becomes the head. Then another pullback follows with decreasing volume, and this pullback's low point is near the same price level as the left shoulder's low. At this stage, you can connect the low point of the left shoulder to the low point of the head with a line. This line is called the neckline, a crucial support line. Whether the head and shoulders pattern fully develops largely depends on it. Why do we say that? Because after the right shoulder peak forms, the price must break below this neckline during the pullback and continue downward for the pattern to be confirmed. Otherwise, if after forming the right shoulder peak, the pullback finds support above this neckline and the price reverses upward, then the so-called head and shoulders pattern is invalid. And of course, no trend reversal has actually occurred. Generally, about 20% of right shoulders exhibit this behavior, causing the pattern to fail midway. For confirming head and shoulders tops, the book provides a quantitative indicator, the decline after the right shoulder. It requires a 3% drop below the neckline to confirm a valid breakdown. Of course, volume considerations are also crucial. If volume shrinks during the right shoulder formation compared to previous rallies, many investors may start selling early without waiting for the full confirmation signal. Lastly, in rare cases, the chart shows confirmation signals, but the price doesn't decline much. This is a false breakout. In most cases, though, when head and shoulders top is confirmed, downward reversal probability is high. Is there a way to predict the decline magnitude? The book offers a simple calculation. Measure the point difference between head peak and neckline, then subtract that from neckline for minimum downside target. After head and shoulders top, let's briefly discuss head and shoulders bottom. It's essentially an inverted head and shoulders top, a common bottom reversal pattern resembling its reflection in water. Generally, head and shoulders bottom takes longer to form. Recalling a Wall Street adage, stocks need buying pressure to rise but fall like free fall objects. Both patterns are fundamental reversals. Other common reversals include rounding tops and bottoms, gentler transitions forming arc shapes over longer periods. Another bottom type is dormant bottom, a extreme flat base lasting months or years with minimal volume, evolving from rounding bottoms. Real charts show many pattern variations, requiring traders to review historical data for better reversal accuracy. Reversal patterns. All right, that's where we'll pause. Now let's dive into consolidation patterns. Consolidation doesn't reverse the trend direction. It's like catching your breath during a rally before continuing upward. It's an adjustment phase during price movements. The main consolidation patterns are flags and triangles, most common in uptrends. First, flags. After a surge, the price pulls back, rebounds, then pulls back again. Typically, this repeats 2 to 3 times. Connect these minor highs with one trend line and the minor lows with another. This forms a slightly downward sloping flag pattern, essentially a parallelogram, often appearing after sharp vertical rallies. That initial vertical rally then resembles a flagpole. So overall, it looks like a flag waving on its pole. Our audiobook notes include an illustration of this pattern. Triangles differ from flags in that their high-low trend lines converge rather than staying parallel. So how do we validate these consolidation patterns? 3 criteria. First, both patterns follow sharp vertical rallies or declines. Second, volume must contract significantly during consolidation until breakout occurs. Third, price should break out in the original direction within 4 weeks. If nothing happens after 3 weeks, the pattern likely fails. About 3% of these patterns become reversals. Crucial to remember, there's no absolute distinction between reversal and consolidation. It's all about probability, higher or lower odds. In actual trading, take it step by step. Don't jump to conclusions prematurely. When judging patterns, gaps on charts also provide valuable signals. For example, on a daily chart, if day one's high is $20 and day two's low is $21, that creates a dollar gap between the price bars. We classify gaps into 3 types: breakaway, runaway, measuring, and exhaustion gaps. Breakaway gaps often appear at trend beginnings, while runaway gaps occur mid-trend, signaling acceleration. Exhaustion gaps emerge near trend ends, warning of impending reversals. A common market superstition claims all gaps must be filled. This may hold in ranging markets. But in strong trends, breakaway and runaway gaps often remain unfilled for years. When exhaustion gaps get filled late in strong trends, it clearly signals trend reversal. All right, that concludes reversal and consolidation patterns. Next, we explore the second analysis method, using trend lines to time entries and exits. In bull markets, connect 2 pullback lows to form ascending trend lines. These provide strong support. A decisive break below signals potential bull to bear reversal. And in bear markets, connecting 2 rally highs creates descending trend lines. These act as resistance dynamics. Breaks above suggest possible bear to bull transition. How do we confirm valid trendline breaks? The book offers 2 criteria. First, breakout magnitude. For downside breaks and uptrends, closing prices must be less than 3% below trend line. For upside breaks and downtrends, prices need approximately 3% above trend line. Second criterion, significant volume expansion accompanies valid breakouts. Caution. If prices drop during uptrends but rebound without meeting criteria, remain alert. Subsequent selling pressure could indicate genuine breakdown. That's all for this section. Next, we cover the third method, analyzing support and resistance levels. A support level is a price where, once touched, significant buy orders emerge. These buy orders can at least halt short-term declines, stabilize prices, or even cause rebounds, while resistance levels face heavy sell orders. Of course, every price level has both buyers and sellers. But support levels are where buyers dominate, while resistance levels favor sellers. For example, in bear markets, we say a stock has heavy locked-in positions at certain prices. That becomes its resistance level. Round numbers like $10, $20, or $100 often become resistance levels. However, once price breaks resistance, it immediately transforms into support. Thus, breaking resistance signals good long entry opportunities. Conversely, breaking support indicates good shorting opportunities. Having covered support or resistance, let's discuss the fourth analysis method. Dow theory is the foundation of technical market analysis. It identifies 3 simultaneous trends: primary, long-term, 1+ years, secondary, 3 weeks, months, and minor trends. Minor trends mainly manifest in daily price movements. Dow theory holds that market indices discount all known information except force majeure events. Minor trends may be manipulated, secondary trends possibly influenced, but primary trends are unshakable. Dow theory has two confirmation principles. First requires industrial and railroad indices to confirm trend direction. Actually, this is Dow theory's most contentious aspect. These indices don't always move in sync daily. Often one index lags the other by days, weeks, or even months. Thus, requiring such confirmation often makes signals lagging indicators. The second principle uses volume to confirm trends. In bull markets, rising prices come with increased volume, while declines see reduced volume. In bear markets, falling prices accompany higher volume, while rebounds show contracting volume. Additionally, Dow theory only considers closing prices. Even a 0.1 point break above prior highs or below prior lows is valid. These four analysis methods, reversal or consolidation patterns, trend lines, gaps, support or resistance, and Dow theory, have stood the test of time. These fundamentals form the bedrock of trading success. All right, let's now move to part two, specific trading tactics. Before entering markets, clearly define your positioning. Will you be a medium to long-term investor or day trader? These aren't mutually exclusive, but it depends on your capital size and daily time commitment. So your temperament also plays a crucial role. Long-term traders capture major trends lasting months or even years. But this strategy struggles in prolonged bear markets. The 200-day moving average serves as a key indicator. If stocks underperform or decline persistently, long-term investors cut losses decisively, holding only strong performers. A golden rule: buy strength, not weakness. Different trader types have distinct stock picking preferences. The book compares the dot-com bubble to 17th century Dutch tulip mania. Crowds swarmed tulip markets like flies to honey, believing the frenzy would last forever. Global wealth flooded into Holland for tulips at any cost, ending disastrously, nearing the dot-com crash. The 2000 NASDAQ crash showed striking similarities. Of course, these bubbles generated substantial returns during their growth phases. For trading these high-risk investments, the book offers 3 warnings. First, cautious investors shouldn't put too much money in. Keeping it to 5 to 10% of trading capital is wise. Second, don't sell too early. Wait for clear peaks before shorting to avoid missing explosive rallies. Third, stay calm and avoid emotional trading. These tulip-like internet stocks can lead to massive losses. Observe charts closely to spot key trend reversals. Buying these stocks requires constant monitoring. Speculation isn't easy. Think Google, Cisco, Amazon. A simple approach: draw trend lines vigilantly to guard against bungee-like crashes. If prices break below trend lines, exit positions immediately. Google itself halved after hitting $700 in 2008. New traders face two sensitive issues: margin usage and short selling. First, margin trading. Many reject it outright. They believe only using personal funds can withstand market risks. Actually, this mindset isn't necessarily correct. Margin trading involves leverage. For example, capital can amplify 5 to 10 times with proper position sizing and stop loss orders. Risks become manageable. Conversely, without stops, even personal funds can dwindle to pennies. The other sensitive issue: short selling. Ask 7 traders, 6 will firmly say, "I never short." This explains why the public always wants rising markets. They only go long, not short. Historically, stocks rise 2/3 of the time, but fall 1/3, with similar magnitude. Thus, bear declines are steeper than bull rallies. So the conclusion is, shorting profits faster in bear markets than going long in bull markets. Whether you're going long or short, every trade should include a stop loss. Stop losses are generally divided into protective stops and trailing stops. In crisis times, protective stops are your financial umbrella, but setting stop loss points remains a deeply troubling issue. For going long, setting it too tight risks hitting the stop loss only for the price to rebound immediately. Setting it too wide risks big losses if the price breaks down. What to do? And the book proposes a simple rule: For stocks around $25, set the stop loss about 5% below the last previous bottom. This is a conservative setting. For stocks near $5, set the stop loss 7.5% below the last previous bottom. And other stock prices can also reference this standard. Now, to the second type, trailing stops. Although called stop loss, it's really profit protection, locking in gains. Example, you buy at $20 with an initial protective stop at $18. After your purchase, the stock keeps rising. When it hits $25, your stop loss shouldn't still be at $18. You need to remove the protective stop and set a trailing stop, say at $23 now. If you didn't sell at $25 and the price falls to $23 hitting the trailing stop order, it executes. At that point, you exit with a profit. So trailing stops protect your gains, preventing a profitable position from ending at $18. As for stop loss methods, everyone might have their own tricks. The book briefly covers this. For instance, renowned trader Bruce Kovner answered this by saying, set the stop where the price is unlikely to go. Another example is an old saying in Japanese markets. When prices hit 8 new highs, sell half. When prices hit 10 new highs, sell half of the remaining position. When the stock price hits 12 new highs, close all positions. In actual trading, there are mainly 3 types of operations: opening positions, holding positions, and rolling positions. First, use the reversal patterns, trend lines, support levels, resistance levels, and gap signals introduced in Part 1 to establish long or short positions. If the price movement doesn't match expectations, you should cut losses and exit. All position openings must first set a protective stop loss. Once the trade generates profits, change the protective stop loss to a trailing stop loss. Good trading tactics. That's all for this part. Finally, we emphasize that technical analysis can't guarantee 100% accuracy. Correct. So you need to be mentally prepared that trial and error is essential in your investment career, or something that will accompany you throughout. Whether you're going long or short, always maintain risk awareness. When it comes to risk management, first calculate how much idle capital you have and how much tuition you're mentally prepared to pay. You can start trading with $500. Of course, having $1,000 or more is better. Don't see the stock market as a place to get rich overnight. Believe in steady long-term growth. Small streams can converge into rivers. Hold on to this persistent spirit. Don't casually believe rumors. After thoroughly researching various analysis methods, develop a trading strategy with higher winning odds that suits you. Given time, you will reap rewards. Stock market trends. That concludes our interpretation of technical analysis for you. The audiobook notes are below the audio. See you tomorrow.